Hi, this is David. Welcome to the video for Part 2, Topic 5, Tuckman's Chapter 7, which is the Science of Term Structure Models from Fixed Income Securities, the third edition. After about 10 years, we finally got a new edition of Tuckman. And so there's a workbook associated with this reading, and the workbook is labeled this way. T5 is Topic 5, which is Market Risk in Part 2 of the FRM. The 29 indicates this is Reading 29 from the 2013 syllabus. And then the 7 indicates Chapter 7 from Tuckman. So we tried to use this syntax here to be a little more consistent with the readings. Reading 29, Chapter 7, and it's the science of term structures, term structure models. This workbook contains 5 worksheets, and so most of those are snapshots that we'll look at in this video presentation. So the worksheets are dynamic and would allow you to learn about these in more detail, especially helpful if you really want to understand what's going on. However, you'll notice I've tagged them with low relevance for the exam, and that just means that if the goal is just to pass the exam, I do not think that you need to look at these worksheets. So they're optional only if you want to reinforce your understanding. This Chapter 7, Science of Term Structure, is really about the interest rate binomial tree. And so Tuckman starts with a very simple example. And you may recall that in Tuckman, the bonds all pay coupons every 6 months or semi-annually. So it's not, we might expect that his interest rate binomial tree has a 6-month time step here, but that's just a design decision, right? And it's a pretty long time step. We could really have 1 month or even 1 day here for these time steps. So he's just decided to keep it simple with a 6-month time step. And this is really the most basic type of interest rate binomial tree because we start here today and then we either jump up or we jump down. And so this is essentially or structurally similar to the binomial tree that we looked at in whole for the pricing of a stock option under a binomial tree. Structurally the same. The big difference is our underlying risk factor. In that case, the risk factor was the movement or change in the stock price or equity price, and we presumed that when we're using volatility, we presume that it followed the geometric Brownian motion or GBM, which did not mean revert. And so there's a big difference here where the underlying risk factor is an interest rate, which we very well may presume is mean reverting. Not right here because that's a little bit more intermediate. We start with something really basic here. And Tuckman starts with the idea that the 6-month rate is 5%. And again, consistent with the binomial tree, which is a series of Bernoullis, meaning we go up or we go down. So with probability of P equal to 50%, this tree just says that the interest rate, that factor might jump up to 5.5%. And because this is a Bernoulli here that informs this overall binomial, if it doesn't go up, it's going to go down. If it goes up with probability P, it goes down with probability of 1 minus P, or sometimes Q. And in that case, it's going to be 50% as well here. And notice there's a symmetry here, so we're not really reflecting any immediate properties. Just something very basic here that if it goes down, it's going to go down to 4.5%. And again, this is the 6-month rate today. And so this tree maps out a possible evolution of 6-month rates. So it means that we go forward 6 months in time, and then this will be the new 6-month rate 6 months forward. As opposed to what we have here is a truncated spot rate term structure. So these are rates we can really observe today. Here's a 6-month rate. Here's the 1-year rate. And this 1-year spot rate is a little bit higher than the 6-month spot rate. And we might expect that. So it's an upward sloping spot rate term structure here. Again, we can totally observe that. It's going to be higher than it is in actual out in the marketplace today. So that's our 6-month 1-step tree. And then Tuckman builds on that by adding another time step. And so now we have a 1-year interest rate tree, and let's be mindful of some notation. That capital T really denotes the 1 year. See how it's a 1 year tree. However, it's comprised of 2 time steps. Each of the time steps is 6 months. So it takes us 2 steps to get through the full year. Now, if these time steps were 1 month, then we would have 12 time steps to get to the full year. So the d of t or delta t, so and Tuckman likes this small d of t, reminds us of the calculus, right? A change in t. And so in this case, d of t is 0.5 years. So our time step is half a year, 0.5 years. We require 2 of the time steps to constitute the 1 year interest rate tree. And so in Tuckman's assumption here, that 5% evolves up to 5.5%. And again, that is a possible future 6-month rate. And then what can happen at that point? Well, it can jump up again or down to a new 6-month rate. So notice we've got here 4 possible paths. We can go up, then up, up, then down, down, then up, down, then down. If we can go up to 5.5% 6-month rate and then jump down to a 5%, which is a 6-month rate 1 year forward. And you'll notice 4 paths, but only 3 nodes here because this tree is recombining, which is to say that if we go up, then down, we end up at the same node that if we go down, then up. 4 paths, only 3 nodes because it recombines. Briefly about notation, we can also call this node 2-1. Why do I say that? Well, because we start with the date, because it's useful when we have a lot of nodes here to be able to reference them. The first subscript would be the date. So this is date 0, this is date 1, this is date 2. Notice that's just sort of reference. That's just a way to reference the nodes, not the same as the time stamps here. Date 0, date 1, date 2, and then we start from the bottom with 0. So 0, 1. So we could call this node of 5% is date 0, 1, 2, comma 1. See how we can call that node 2, 1, 0, 1, 2, 0, 1. Okay, that's just about the notation. And again, though, although this is a path of possible evolution of rates, it's different than the spot rate term structure up here, because these are rates that we observe today, spot rates as of today. The 6-month spot rate is 5%, and notice the 1 year spot rate is 5.15%. So none of these rates down here are 1 year rates, are they? They're all possible future 6-month rates. This is the 1 year spot rate today that we can actually observe. This is the 1.5 year spot rate that we can observe. Okay, so the aim is, and what Tuckman describes, is calculate the expected discounted value of a 0 coupon bond using a binomial tree. And this is a simple 0 coupon bond that happens to have a maturity of only 1 year. So we're only 1 year out. That means it's going to, we only really need a 2-step binomial. So it's just a way to keep it simple. We've already got our previous assumptions. And the expected discounted value here is $951.82. And here's the same, just using discount factors instead. And so expected discounted value is also structurally similar to what we saw in the binomial for equity pricing in the sense that it's a backward induction. And we have a 0 coupon bond here, par of 1,000, with only 1 year to maturity. So you remember the pull to par? Well, the pull to par means that in 1 year, this bond's going to mature. So a really handy feature of that pull to par is we know that the price of that bond is going to be 1,000 as the price gets pulled to its par value. So that's very handy to know that regardless of the path, each of the 3 nodes here at maturity is going to be the par value. And now the this node here, which I could reference this as date 101, and then we go starting from the bottom 01. So I could call this node 11, couldn't I, of 973.24. Notice is just it's that backward induction. It's both of these values are 1,000, so it doesn't matter how I weight them. I can just take the 1,000 and discount it. Notice implicitly we've got discounting with semi-annual frequency at 5.5%, because if we're in this node, then that 6-month rate at this future time is 5.5%. So you see how the 5.5% is being used to discount these values out here to here. So we're taking $1,000, discounting at 5.5% with semi-annual frequency to get the 973.24. So that's really the discounted portion. You've seen this before, just basic discounting. Same thing for the 978, so we're also discounting 1,000 here because the weighting doesn't matter. But in this case, we're discounting with that 4.5% here. And so notice we're going to get a higher price here. And so now these two nodes, again, what I like to call backward induction here, to get the 950.182, notice there's really two parts to this, and we saw this before. First, it's a weighted average, right? Because we have this node here says, okay, in 6 months we can have two different prices, each probability P, probability 1 minus P. So we're really taking in the numerator here a weighted average, aren't we, of these future values. So that gives us the expected value here at 6 months, and then the denominator is the discounting. And if we're here, it's 5%, so with semi-annual. So see how we're taking a weighted average, discounting it to get the expected discounted value. So this phrase, expected discounted value, see how it's got both of the parts in it? In the numerator, the expected here is just taking a mean, isn't it? And then the discounting is here in the denominator. So that's our expected discounted value, and it tells us that that 1-year 0 coupon bond has an expected discounted value today. This is a present value of $951.82. Now, Tuckman then goes into maybe the most technical aspect of this reading, and illustrates how we can use a replicating portfolio to price a call option. So here the assumptions and then a replicating portfolio. And so the idea is that we're replicating an option on a bond, and the option, so that's a call option on a bond, on the 0 coupon bond, and the call option has a strike of $975. So that's a strike price to purchase that bond. And the idea is, can we replicate the mechanics of that option under the binomial tree with a replicating portfolio? And the answer is that we can, if our replicating portfolio consists of a long position in a 1-year bond and a short position in a 6-month bond. And so that's really just solving for two equations and two unknowns, and the solution to that formula is here, the replicating portfolio, and it says that if we go long the 1-year bond in a face amount of 629.34 and combined with short the 6-month bond in a face amount of 612.50, then notice what happens. And by the way, my numbers are slightly different than in the Tuckman reading, and I checked, and that's only because I didn't do any rounding here. He rounds off, and if I round off, I get his numbers as well. So the short version to the difference is that mine are more precise, actually. Okay, so notice that if we have this replicating portfolio here, what happens under the interest rate binomial, under the interest rate tree, is if there's an up jump, then the bond prices to 973.24, and that call option with a strike of 975 is going to be worth 0. And what about our replicating portfolio? Well, we're long this face amount, so it's face amount 629 and the price of 973 means the value of our long position is going to be 612.50. The spreadsheet will just show that's just the 629.34 multiplied by the 973.24 divided by 1,000, right? Because we bought this much of face amount, so we could just multiply this by this. And that means the value of that long position is going to be 612.50. And similarly, a short position in the 6-month bond of 612.50, well, the 6-month bond in 6 months is going to be worth its par. And so if we have this amount, if we have 612.5 of face amount, that's going to be its value in 6 months. And so in the up path, our replicating portfolio long the 1-year bond plus short the 6 months is going to have a value of 0, exactly equal to the value of the call option. What if we go down? If we go down, then the bond price will be 978. Remember, that's with the lower interest rate, so the higher price. And that call has a value of $3, 973, intrinsic value 978 minus 975. That same replicating portfolio, face amount long, face amount short, is going to have, the long bond's going to have 629.34 multiplied by 978 divided by 1,000. It's going to have a value of 615.5. And again, that short 6-month bond is going to have the same value because it's maturing. So it's the same 612.50 of the face amount. And that difference there is $3. So under the down path, this replicating portfolio has a value of $3 matching the call option. And so that's the idea, that the payoff of the call option, which is to say either a 0 and up or a 3 and down state, is replicated by this portfolio. So instead of buying the option, we can buy the replicating portfolio and have the same exact expected payout, of course, assuming the binomial tree. And so the idea there is, okay, what's that? That replicating portfolio has a cost of 58 cents to us. That replicates the option. That's the cost or price of the option. And so that's the replicating portfolio basically applies an arbitrage argument to price the call option. So we figured out a price of the option because we figured out a way to basically simulate the call option by taking a long position in a 1-year bond and a short position in a 6-month bond. And so this slide just really is the text that describes what I just showed. So I only have this in the slide just for those people who would like to read the slide. And then now immediately then we're going to notice that we got two prices. We got an expected discounted value of $1.46 if we do that discounting on the option, as opposed to the 58 cents under that replicating portfolio. So what I mean is that we've now gone from the bond to an option on the bond, and then in 6 months it's going to have, that option is going to have a value of 0 or 3. And recall, we've been saying that the probabilities, or true probabilities, are 50% up and 50% down. And so previously to compute the discounted expected value, we took 50% of the 0 times 50% of the 3. So it's just 50% times the $3. That's $1.50, and then discounted it at the 5%. So the expected discounted value of this option on the bond is $1.46, but that's different than the 58 cents we got under the replicating portfolio. And so Tuckman's point here is that the true price, and so we're going to call this the risk neutral price, and we're also going to call this the arbitrage price, is less than the discounted expected value. And in fact, we could figure out what these probabilities need to be in order to in order to actually do the expected discounted value and produce the 58 cents. So if we use the 50/50, we get the $1.46. But if we change these to 80 and 19 approximately, we'd get the 58 cents. How could we reconcile that? Well, the primary way to reconcile that is to recall that by the expected discounted value really just took the weighted average and discounted it. And so there's really no risk aversion in that. And so Tuckman says that investors dislike the risk of the call option. They would probably pay less than the expected discounted value. So it should match some intuition that we want to pay less than this to the extent that we're risk averse. Now, what about the aim says explain the role of upstate and downstate probabilities in the option value. And so this is the fascinating part of this. And this is a little bit of a trick aim in a way, because the role is they have no role in a way. And that's where this is what Tuckman says: the remarkable feature of arbitrage pricing is that the up-down prices never enter into the calculation of the arbitrage or risk-neutral price. So of course that 50/50 did inform the 146. If we change the 50/50 in yellow, we'll get different values for the expected discounted value. However, that risk-neutral price was informed by a replicating portfolio that is going to be indifferent to the changes in the up-down probabilities. Risk-neutral pricing modifies an assumed interest rate process so that any contingent claim can be priced without having to construct and price its replicating portfolio. And so now we get to the idea of the risk-neutral probabilities. Well, what are those really? Well, we've taken a zero coupon bond with 1 year to maturity, and recall we start here with the interest rate binomial tree and these probabilities of 50% and 50%, 50% up, 50% down. And we call those real-world probabilities. And then if we apply those then by using that discounted expected value, we would get a price on this bond. I'm back to the bond, not the option now. I'm just following Tuckman. Is 951.82, right? So that's expected discounted value given by our real-world probabilities. Okay, then what we can do is say, what we can do is look at the market price. In this case, the price of 950.42. That's really informed by the 1 year spot rate of 5.15%. And so we assume that although this is the expected discounted value, we actually observe a price for this bond of 950.42 that's slightly less, presumably to reflect some risk aversion. And so the idea is we say, okay, well then let's just change these real-world probabilities into risk-neutral probabilities. And so in this case, if we increase this probability here for the lower value, if we increase it above 50% at some point, then doing the discount expected value here will produce for us the 942. In other words, can we find probabilities that if we use those and then compute the expected discounted value with those probabilities, that the expected discounted value will equal the price that we observe? And so here they are, and we call those the risk-neutral probabilities. Under the theory that, okay, these probabilities reflect where we end up, that really make us neutral with respect to our risk preferences. So again, here with 50/50, we have the so-called real-world probabilities where the expected discounted value is 951.82. But because the market price is 950.42, the risk-neutral probabilities are modified, or really change these. So we really solve for them in order to get a price that matches the market price. And so then some slides just on the basic steps for the text we have 4 steps for risk-neutral pricing. Step 1, given trees for the underlying securities, the price of a security is priced by arbitrage, does not depend on the investor's risk preferences. Step 2, we imagine an economy identical to the true economy with respect to current bond prices and the possible value of the 6-month rate over time, but different in that investors in the imaginary economy are risk neutral. Unlike investors in the true economy, investors in the imaginary economy do not penalize securities for risk and therefore price securities by expected discounted value. And so that's what we just did. It follows that under the probabilities in the imaginary economy, the expected discounted value of the 1-year zero equals its market price. That's the essence of what we just did. We found those probabilities that made this statement true. Those probabilities were not 50-50. They were adjusted into roughly 80-20. Then step 3, the price of the option in the imaginary economy, like any other security in that economy, is computed by expected discounted value. Since the probability of the upstate in that economy is 80%, the price of the option in that economy is given by the equation that discounts with that 80% or 58%. And so finally, step 4, where generally we say the price of the derivative in the real economy may be computed by expected discounted value, but not under the true probabilities, but under the risk-neutral probabilities. Almost by definition, it's almost a circular exercise where we've justified our probabilities simply by calibrating to the observed market prices. And so we could say that that informs the interest rate drift because under a 50-50 real world or true probabilities, the expected drift is 0. But when we go to adjust to the risk neutral probabilities where we have an 80% chance of an increase, then you can see the average of that is above 0, is non-zero. So under the risk neutral probability, really implicitly, there's an assumption that the drift of the 6-month rate is positive, or in that case, about 30 basis points. And now the 3-step, it just extends the idea. So here we've got an interest rate tree again. Now we've got 2 steps going out 1 year. We've got a bond price of 925.21. 3 steps. So really it's 1.5 years to maturity, or it's an 18-month bond. And you can see our price per discounted, our expected discounted value price is 925.21, and it matches the market price, which is to say that par discounted at 5.25% over the 18 months. Why does it match? Well, because I've got in there risk neutral probabilities. I don't have the 50-50. Notice here I've got the 80, almost 80-20. And notice we have slightly different risk-neutral probabilities out here at these nodes. But otherwise, the essential same process. If I have these risk-neutral probabilities and they're correctly calibrated, then we discounted expected value. We get 3 nodes here. Those discount again to these values. Those discount again. Because we have risk-neutral probabilities, the 925.21 matches what we would get if we just took that 0 and discounted it 18 months over that spot rate. So put another way, our risk-neutral probabilities are consistent with the spot rate, the 18-month spot rate assumption. And this is, again, also a recombining tree in the sense that we have noticed, if we take this node here, which we could reference as date 0, 1, 2, 3, and then from the bottom 0, 1, 2, so this could be node 3, 2. We can reach that variously. We could go up, up, down. But we could also go down, up, up. So that's a recombining tree. And the rationale behind the recombining tree is basically that it's practical. There's nothing wrong with doing it. The problem is that after we end up with lots of different nodes. Notice this, a tree with semi-annual steps large enough to price 10-year securities will in its rightmost column have over 500,000 nodes. Wow, that's very high. It's hard to believe it's so high. So it's really nothing wrong economically with non-recombining. It's practical. We just have a lot fewer nodes to deal with. We're asked about a constant maturity treasury swap. And here the assumption is that we're pricing a CMT swap that pays a notional divided by 2 because it's every 6 months. The difference between the treasury yield and 5%, we could call that the swap rate or sort of a fixed rate or even a strike rate here of 5%. And so the idea that, again, that we have an interest rate evolution with risk-neutral probabilities, and in this case, it's only a 1-year swap. So that means we get out here to 1 year, and it's going to simplify here the calculation of our payout here. In the up node, we end up with a 6% rate. So notice the 6% minus that strike or fixed rate of 5%. 6 minus 5 is 1%. Times the notional of $1 million is 10,000. And it's half of that, so 5,000. So we've got those payments out here. And then it's that backward induction here. The only thing is we're discounting and present valuing, but we're also adding in the payoff that would occur here of 25,000. So you can see this 5658 includes basically sort of a midpoint here, but not really. It tilted toward the high side, then discounted back. So that's going to be a little above 2,500, adding into this payoff here at 5.5%. And so then those PVs also come back here to 3,616. What are the advantages and disadvantages of reducing the time step? Well, the advantages of reducing the time step is that presumably we'd get more accurate. If the cash flows do not occur at given intervals, reducing the time step should get us closer to actual cash flows, allowing us to price with greater accuracy. So that was similar to what we saw with the reducing the time step in the binomial. You may recall for equities that are reducing that where we use volatility to inform the jumps. As we reduce the time step, we got closer and closer to the actual log normal under the Black-Scholes-Merton. So basically more accuracy, but we're going to increase computation time, and we needed to pay more attention to numerical issues. So the difference between these fixed income and that binomial in the Black-Scholes, that basic difference is that our bond is not like an equity, and the risk factor of interest rate is not like that underlying stock factor, in the sense that our bond is pulling to par, right? So the price of a bond must convert to its face value at maturity, but that stochastic process in the Black-Scholes was not constrained that way at all. And then finally, we've got a legacy aim in here. Describe the impact of embedded options on the value of fixed income securities. It's a legacy. This is a sort of a hanging aim because we've already looked at including the option in the bond. But just a general point there, right? We can have prices of the bond, and then we can have an option. We can price the option in reference. It's just an additional layer on the model. We can have a basic tree that plots out the price of the bond, and then at maturity of the option, we'll be able to take the intrinsic value, just take a look at the strike versus the actual price, and then we can do backward induction on the option. So we're just it's just an additional layer on the tree. We're going to be okay as long as we go out to maturity, where we can look at the intrinsic value of the option. And that concludes the video for Tuckman Chapter 7. Thanks very much.